Hey everybody, welcome to video number 14, or I should say episode number 14 of the Note Closers Show. It is Tuesday, November 22nd. We're literally just 2 days away from Thanksgiving. And today's topic is about overanalyst paralysis. I talked to so many people and so many investors, they just overanalyze everything to the nth degree. And I'm notorious for kind of poking fun at engineers, all right? Engineers like to overanalyze and go down. And one of the things about note investing, when you're buying defaulted notes and you're making offers and reaching out to hedge fund managers and banks, is you can't overanalyze in the front end. I mean, many people do, but if you overanalyze and try to do everything on the front end, by the time you actually pull the trigger to make an offering, most of the time an offer's already been made, that list has been pulled, somebody's bought the deal. And so what I have found is those people that struggle with overanalyst paralysis, they do it throughout their entire life, through everything. They overanalyze everything. And you unfortunately, you can't do that to get ahead in today. You've got to be willing to take action. You got to be willing to move forward with things to really help you achieve. Now, are you going to make mistakes? Yes. A lot of people are afraid to make mistakes. That's why they overanalyze. But some of the best things in life have come from making mistakes. You know, like champagne. You know, bubbly has come from making mistakes. The monks made a mistake and voila, carbonated the wine. And voila, we have bubbly, which is great. And yes, this is a big freaking bottle of champagne. It's just not an illusion. It is huge. Anyway, you have to realize that you will make mistakes. You're going to goof up on things. But one of the great things about the note investing game versus traditional real estate. Now, traditional real estate, you have a property. It's a true property. That's what you're bidding on. With notes, you're buying the debt. Okay? And since you're buying all across the country, for the most part, or outside of your own backyard, when you submit an offer, an initial offering, most of the time, it's just an initial offering. It's not the final number for the most part. There's many things that can happen to reduce or fade your bid down. I'll give you an example. The property looks good online. The numbers make sense online. And so you don't have time to get a realtor to drive out there in the next 48 hours to make a bid. Give you an example. It's this week. A lot of realtors don't work. So trying to find a realtor to drive by a property on Thanksgiving or Friday or Saturday or Sunday this week when many people are with families is difficult. So if you're making offers this week, you got to expect you're probably not going to have a realtor till Monday or Tuesday. So waiting around till Monday or Tuesday to get a realtor, and if you're looking at assets today, isn't going to work. Get an offer in, do the best you can with online through Zillow, Trulia, pull on crime values, recently sold on the bottom of Zillow, NAR, RPR, Red Bell. There's a whole variety of different websites out there to try to get an automated valuation model online. Do that. Get your bid in, get the numbers working, call a realtor or two or three, use Active Rain or hire somebody, we go look or pay for a BPO from a company, and then have somebody look at the real estate and drive by. Now, the numbers may differ. That's okay. If your online value says 60, and that's what the hedge fund thinks it's worth, it's 60, okay, great. But your realtor drives by, hey, there's a hole in the back, or it needs lawn mowing, or the siding's falling off the house. We can then agree it's not worth 80. Maybe it's worth 60 at the point. There are a lot of things that can reduce your value down. And maybe maybe it's got a tax sale coming up. Maybe there's more gang in the area, or there's ugly properties across the street. It's okay to come back to the hedge fund and say, let me reduce that down. All right? Let me reduce this down. Okay? Not every deal is going to work with every exit strategy, too. A lot of times, you have to identify really three major exit strategies. One's going to be to modify or reinstate. You know, you're going to depend on whether it's a modification or restatement based on what the existing payment is versus the market rents. Two is going to be cash for keys, deed in lieu. You hope for that. That's always a nice thing. And then third's primarily going to be to foreclose. All right? And then worst case, you want to run numbers for what would it be after you foreclose if you had to turn it into a rental. And yes, I know you're not going to get interior conditions of the property. You're not going to be able to know if it needs rehab inside the property. You can tell a lot about a property by the exterior factors. If the lawn's mowed and there's toys in the yard, okay, or they look like they have kids, or it's a decent car, okay, a house is upkept, flag on the front door, you know, plots, plants. If somebody's living in it, that's a good thing. All right, because if you can reinstate it, you're not going to have to fork over the money to repair it most of the times. Okay? Now, if it is vacant, that's when you have the most amount of money going, because you do have to foreclose most of the time. You do have to put probably some work into it. That's why you really want to peek inside the house or talk to local agents to see if they can give you an idea, or even maybe talking to the neighbors to find out what the house looks like inside. So many people want to overanalyze things. And in our workshops, we have our one-page short due diligence checklist, and we have like a 17-page, engineer's wet dream checklist. Okay? Yes, I know, it's funny. People are like, oh my gosh, this is awesome. I'm like, if you go through everything on that checklist, you will never get around to buying an asset because you'll be too busy checking lists off and not submitting offers. All right? So if you are struggling with overanalysis paralysis, I know that some people out there, I've had people that we've coached that said, oh, I want the perfect deal before I do anything. And I'm like, I can't work with you. I'm sorry. You're going to have to go somewhere else. Because exactly. There is no ideally perfect deal. That same thing as a unicorn. Every deal has a facet to it that's a little bit different. Every deal will tell its own story. And you're like, well, Scott, how can I put a perfect cookie cutter deal in place? Well, you try to work your numbers. You try to stick to specific assets. You try to stick to owner occupied. That helps you out the most. You try to find assets where the rent rate is higher than the existing mortgage payment. There are some things you can do to alleviate that exit strategy, phobia. All right, maybe you stick to 1, 2, 3, 4, 5 states. Don't try to buy assets in 30 states. For pricing, you try to use the stair-step method as a guide. All right. If you suffer from overanalysis paralysis, I guarantee it's just not notes that you suffer that with. If you can do anything to help yourself, it's okay to make a decision, and it's okay to make a mistake. You learn more from your mistakes, and as a buddy of mine likes to say, you can't fall on your face without falling forward. And I learn more from my mistakes every day. I've learned more and made more money off the mistakes that I've made in the past that help me learn and direct myself going forward on different things. So that's a huge, huge thing. Try to really make a decision, partner up with somebody, find somebody accountable to help you kind of hold your hand and walk you through it. Find a mentor, find a mastermind group to help you with things, because that's going to help you more than anything else. We see that often, especially with our magical mastermind coming up. People come and then they get a list of 1,000 assets and they just flip out. They have a mental breakdown. Their brain stops working. They got smoke coming out of their ears. Must look at every deal. And it doesn't work that way. It's okay to, get rid of half the shit you're not going to look at. That's the first thing. Narrow your list down if you're suffering from looking at things. Easiest thing, just get rid of the states you don't like. New York, New Jersey are the two that I cut first and foremost. Not saying they're bad markets. It's just that you have to be expected to be in those deals longer. If you need fast foreclosures, then you want to be focused on North Carolina and Texas and Georgia, Arizona, and Nevada. Not that you're going to find a chunk of deals in those those states, because everybody likes fast foreclosure states. I want to commend Karen Peterson, who we had her on last night on our Monday note, and she talked about the fact that she'd gone out to Indiana and looked at close to 30 properties over 2 days. That's a lot of drive, especially in small towns. If she would have done it again, she probably would have removed the small towns, taken a few hours, gotten rid of a lot of the smaller towns out there, but kept the Fort Waynes, the Kokomos, the Anderson, the Indianapolis, the West Lafayette, the South Bend, those bigger cities in Indianapolis versus some of the smaller ones out there. Because why avoid small towns? Well, if you're in a small market, fewer realtors, fewer buyers, fewer rehabbers, you just have a lot less of resources for you and buyers that could eventually buy that property or stay in that house for you. So avoid the small towns. That's another thing to get rid of. Get rid of the mobile homes or manufactured homes. If you don't like duplex or triplex, just stick to single family homes. There's so many ways to clean your list up when you're making an offer so that you can eliminate the overanalysis paralysis. Now, one thing, any realtors that are watching this, I know so many realtors get so bogged down, like, oh, I can make this work. There's a buyer for everything. I look at 1,000, I got 1,000 potential listings. No, that's not the way it works. Quit thinking like a realtor, think like an investor. What's an investor do? They go after their specific target. They're very focused on their niche. They avoid outside distractions. They get rid of the shit that doesn't make sense. and they focus on the 80% of stuff that they're going to make profits on, or the 20% that brings in 80% of the profit. So do yourself a favor. If you have not made offers, if you have not closed on your first deal, really start to identify the markets and really strive to start making some offers. Pick up the phone, start calling some of the asset managers. Jump on Watermark Exchange, jump on Loan MLS, look at some of those bulk lists that let you cherry pick, and start making offers. And you've got time right now before the next year to really take a lot of action and eliminate this overanalyst paralysis, because you can, the more deals you break down individually, the more comfortable you're going to be, the better you're going to be at making offers. And you know what? You're probably still only going to get 30 to 40% of your offers accepted. Not 100% of your offers are going to be accepted. And if they are, either you bid on assets you probably shouldn't have, or you are doing the right thing, especially if they get outbid or people are buying them out from underneath of you before you get around to it. So that's all I've got today. We have any questions, comments, concerns from people?
Natalie Patton says she agrees. It's the fear of making mistakes, but the greatest lessons I've learned have come from those mistakes. Exactly.
Natalie's one of the greatest at breaking down assets. Her and Wayne Snell with Platinum Ventures have done an amazing job this last year. Yes, you learn so much more from your mistakes. Oh, I missed that. That's the beautiful thing with notes. If you're doing initial due diligence, get a bid in, they're going to come back with an acceptance, a counter, or denial. If they accept or counter, then you really dive down into it and make things happen. What else do we have?
That's it.
That's basically it.
That's basically it.
Appreciate it, guys. Have a great Tuesday. The replay from last night's Monday Note is up on vimeo.com/WeCloseNotes. You can catch that. If you have not gone out and donated to the drive to get the We Buy Houses trademark canceled, do so now. It's hugely important. That was another guest last night, Brad Chandler, shared with us. I've donated money. I want to thank some of the other people out there, George Crocker, Jerry Briggs, some of you guys out there that have donated money to that cause. Hey, every $25 helps, guys. We really need to raise funds to help Brad take this and get this canceled, not only for us, but for every real estate investor out there. So if you go to my Facebook page and see the post, please feel free to share it. Donate $5, $10, $25, whatever you can handle to really help us all have a better next year. So until tomorrow, guys, have a great Tuesday, and go out and make something happen today. We'll see you guys at the